Good afternoon, this is Blake Young with TheoTrade's evening video for January 19th, 2023. And today we're going to be talking about little news, little movement. Today's moves in the market were pretty subdued. We ended up netting out a near flat day in the markets, at least for the major indexes, despite the fact that we reached the peak or the debt ceiling in the U.S. Janet Yellen, the Treasury Secretary, indicated that not only did we hit the debt ceiling, that we could fund the U.S. government potentially all the way out into June. And maybe that's what pushed the fear down. Well, we have the ability to fund the government all the way till June if we cut spending for or adding more funds into the civil service retirement system. And if we end up cutting out and avoiding paying for the Postal Service Retiree Health Benefits Fund. Now, that does not mean that they will not get the benefits. It just means we will not be continuing to contribute into those areas where that fund can grow and continue to pay for those benefits for government officials. Now, we could go through and say it's about $1 trillion for the Civil Services Retirement of Disabilities Fund, but that's the total balance. So they'll be drawing down on that to meet the obligations. It'll be putting us into a unfunded or unsupported obligation. Same thing with the Postal Service. The Postal Service is about $40 billion fund, and so we'll be able to draw down on those, and that gives us some time to meet the interest payments and the costs associated with keeping the government running, again, until about June. The rest of the news today was pretty benign. We saw Philly Fed Manufacturing Index, which follows the Empire State Manufacturing Report, in showing a major drop. Empire State Manufacturing fell to negative 30-some%. Philly Fed Manufacturing is negative 9%, well, negative 8.9%, showing that manufacturing is still slowing considerably. We might expect that to be an early indication that the economy is slowing, and we're going to see more slowing because manufacturing has to meet the demand of its buyers. So manufacturing is oftentimes considered one of the earlier indications. But again, it's not a big, important report. Weekly unemployment claims were a little bit better than expected. Again, not that important. Tomorrow is actually pretty subdued as well. Tomorrow we're going to be looking in the U.S. for existing home sales, and Fed member Waller will speak. But existing home sales are expected to miss a little bit, showing that slowing down in U.S. housing. But again, that's not the big deal. The big deal is this debt ceiling that we're hitting and the fact that we're not responding, reacting to it. Yes, we have solutions. And as Janet Yellen said, extraordinary measures are being taken by not funding what is already an obligation of the U.S. government according to the budgeting. Now, this U.S. debt clock obviously is not exact. It's just an idea. It's mathematical extrapolation of what is going on. But I think it's close enough that we can use some of this for some ideas. You can see the U.S. national debt is about $31.5 trillion. That's trillion with a T. That's not really what I want to talk about either. As we look through here, you can see we're spending about $6 trillion. We're bringing in enough that we are in a deficit of about $1.4 trillion. That means we're bringing in about $3.6 trillion in revenues every year. Great. That means we're going to continue to add about $1.4 trillion in deficit if we don't keep spending $1.7 trillion in other measures. You can see this has gone up quite a bit. Based off our debt to GDP ratio, we're at 121%, which is not great. It's not the worst it's been, but it's not great. Now, as we look down here, a couple things we want to look at is this interest on debt. Theoretically, the net interest on the debt is about $520 billion a year. Now, if we're making the assumption that this is accurate, and it's close, then we're paying about 2% interest on the current debt, which is fine. 2% is cheap. Well, when we had 0% interest and we were staying sub 1% and reissued a bunch of the debt, that's fine. That's not going to hurt us. That 2% interest rate on U.S. debt is quite a bargain. But the issue we have is not only are we not raising the debt ceiling yet, but we're issuing new debt. And we're issuing new debt at higher rates. The fact that the Federal Reserve has raised rates throughout the year means that we're going to be paying a higher interest rate. Of the $31.5 trillion, nearly 50%, 45% roughly, 45% of all the debt of that 31 trillion is short-term. short-term maturity. 3.5 years is that average. Now, if we were to look at the Treasury yields, and we're going to go and say, look at the 10-year Treasury yields and look at the 2-year Treasury yields, we would see that that short-term rate is going to be higher. If nearly half of the debt reaches maturity in 3.5 years, that tells us that we will have a higher interest rate for approximately $15 trillion of debt. Now let's do some quick math. If we're assuming that $15 trillion are going to be higher interest rate, right now it's averaging about 2% across all the debt, but $15 trillion is going to be reissued. We're not even talking about increasing the debt load. We're not even talking about raising the debt ceiling. We're talking about just reissuing debt. $15 trillion at 2%, that would be consistent with what we are already at, $520 billion in interest alone. But if we're going to increase $15 trillion, not at 2%, not even at 3%, but a terminal rate for the Fed funds rate is theoretically targeting 5%. And we're in the 4s already. If the average of that 3.5-year maturity is the 1 year, the 30 days, the 60 days, the 6 months, the 2 years, and the 5 years, so we end up with that same average, and we're near 5%. What is the difference of 3% on $1 trillion? Now, this is only theoretical. But theoretically, we're talking about an increase of 15 to 45, 15 times 3%. That means we're going to have an additional 450 billion in additional interest expense. Now remember, we're already at a deficit of about $1.5 trillion. That means our deficit, without spending any more, without raising the debt ceiling, without issuing new spending bills, our deficit will go to $2 trillion. That's the deficit between budget and revenues, which means that we're going to be adding $2 trillion a year to the already $31 trillion. That this 450 is where we add to this, and we're now talking about $970 billion in interest alone. Not even the cutting of the spending and funding of those other departments is going to save the U.S. from default if we don't get this under control, if we don't see some cuts, some spending cuts. Now, one of the things you will see is that we're going to save the day by raising the debt ceiling. What is raising the debt ceiling? Let me explain what raising the debt ceiling is to you and I. If you have a credit card that has a $10,000 limit and they say you must pay every single month 3%, well, that means you're going to be paying $300 a month in interest. If you don't, this is going up. But we've hit the $10,000 limit and we have no excess income. In fact, we're already overspending. So what do? Raising the debt ceiling is saying get another credit card or have them raise what we can borrow to $20,000. And then what do? We still have a $10,000, now $10,300 balance. And if we're raising it as fast as they are, we're really talking about raising it another, what would that be? 1/15. So we're talking about raising another $800 a year. So we're talking about the first year, we're now at $11,000. Well, if we raise the debt ceiling or raise our credit card's balance, available balance to $20,000, we're not getting out of debt. But what we're going to do is now borrow that money to pay the interest rate increase. That's what raising the debt ceiling is. So if we go to $20,000 that we can spend up to $20,000 on our credit cards, it's not that we've paid the $300, it's not that we haven't seen it increase to $11,000, but now on $11,000 we're paying $11,000 plus the interest rate of 3%. Oh, but that 3% is now going to go to 5%. So now as we're paying the 5% on the rate, on our credit card rate, what are we really paying? We're paying with our credit. The $11,000 now becomes $11,550 because we have 5% interest rate. or 5% payments. Let me put it that way, 5% payments. So as we raise this, not only is this going higher and higher and higher, but we're also still hitting our deficit. So the very second year, we're maybe at 12,550. The next year, we're maybe at 13,000, 14,600. And we're going to hit that debt ceiling again. But it's not because we've made more revenue. It's not because we've cut spending. We haven't reduced our deficit. Our month-to-month and annual overspending is still climbing. And we're headed for that 20,000. And we're just using the 20,000 to pay the 550. That's not a good plan. And that's what we're dealing with. So the markets are unsure because we're saying, oh, we've got a solution, so we're not going to default. The great thing about the U.S. government is we've never defaulted on debt. That's what makes the debt worth something. That's what creates that value in the U.S. dollar. Well, the U.S. dollar actually dipped a little bit today, but we're still in a tight range. We traded back and forth, back and forth, back and forth in this overbought area. Remember the high correlation that we see in U.S. equities to the U.S. dollar. Well, U.S. dollar, generally, if the U.S. dollar fell by 0.3%, then theoretically we would expect to see the U.S. equity market go up by 0.75. What happened today in the markets? Well, we went up. Nope, we didn't. We went down. We actually closed down. Not a big move. Like I said, it's a pretty small move. When we look at the open to close, open price in the futures market was $39.45, and we closed the day at $39.20. So 25-point total movement in the market. Well, 26 right there. 26. So equities fell and the U.S. dollar fell. That means we're running away from the U.S. dollar and U.S. equities. This debt ceiling being hit and kicking the can all the way out to June did not curb the uncertainty, the volatility, or the fear that went into the market. What we saw is, as we're watching the markets, the volatility jumped. We climbed all the way up to 22. That's a big move. We're talking about a move of about 8% before settling back down slightly, or to close up slightly. But the volatility is trying to climb because we are very unsure. One of the few areas that we saw strength is we saw strength in communications and healthcare. Well, the communications was lifted almost exclusively by Alphabet, or for the layman terms, Google. So communications are all the way up through here. We see a little bit of a bounce, but we have a strong resistance that we have to deal with still on this. If we take a look at Google directly or Alphabet directly, you can see this move through here. Isn't it a widening pattern and a larger candle? It's a good sign for Google. It's a higher low. We could easily go up to 100, and I think there's a possible opportunity to sell puts in this if we're going to drift higher. But I would also start looking for opportunities to short other stocks in XLC. Primarily, I'd be looking at shorting stocks in the technology sector, including Microsoft. Microsoft's announced more layoffs, more struggles, more downside, and you can see as we approach earnings, this is a definitive lower high, and we should be heading back down to about 220, 221, and looking at another 5% drop in Microsoft, possibly before earnings. And if earnings miss, which is what they're preparing us for by telling us about the layoffs and more layoffs and more layoffs, then we could see Microsoft test and break annual lows. So where's the safety? We keep going back to the same idea. The safety is still going to probably be in the defensive sector, something like healthcare finding support at the oversold area on the distributions, or the monkey bars, TPO. This would be a bounce at support, and it might give us some opportunities to look for bullishness in healthcare. Some of the areas that I think are going to hold up in healthcare are the generally taking care of ourselves, which would be United Healthcare, a solid bounce in the oversold area. We're after earnings here. That's a good massive, that's a big baby, if you want to call that an abandoned baby. That's a big, large bullish candle, and I would be looking for United Healthcare to bounce to 496, but you could also get away with selling puts here. Consumer staples did not have a great day today. Consumer staples fell, and basically anywhere you'd see money spent, we're seeing drops. XLY, XLP, where consumers spend most of the money, we're not doing well. And see, consumer staples fell and fell. I would be looking at the best of the best in consumer staples and saying, where could we find stability? A couple things to note. We have PG, one of the biggest. And you can see preparing for earnings, we've gone from 150 down to 142. That's almost a 10% drop there, and earnings are tomorrow morning. the market is pricing in a massive miss, and we probably have a follow through to 140, but that's a big miss for Procter & Gamble. One of the few areas that we saw stability in the consumer staples or non-cyclicals are the cigarette companies. And well, we shouldn't leave it alone to the cigarette companies. Cigarette companies, and these are people that own or are part of Kraft and Nabisco and all that big, massive conglomerates. But Philip Morris, you can see a gap down, close up. Stability here. It's not that something I expect to be a big mover, but a defensive area. It could be an area where you could sell puts and put verticals down below 100 to collect those premiums. Same thing with Altria. Here's MO. Altria is doing a similar situation. I do not have that monkey bar up, but the Altria is testing short-term support, and we still have a couple of weeks before we get to earnings with them. Now, the last one I want to talk about is energy. Energy is a concern for multiple reasons. Not only are we hitting our debt ceilings, not only are we seeing the struggle that we're going to continue to spend money and higher amounts of money from the government, the fact that energy is bouncing and moving higher also means that interest and inflation is not done. We're seeing that inflation is climbing again, that the cost of energy is going higher, and if the cost of energy is going higher, transportation is going higher, and therefore our food prices are not coming down. And we've talked about this earlier on. The double-digit food, double-digit energy, double-digit cost to repair your car, double-digit for utilities is an indication that we are still going to have high interest rate or high inflation and less spending. So lower demand, lower growth, and higher interest rates could continue to push the Fed to raise rates while pushing the economy into more of a recession type behavior. So we want to be as defensive as we can, and we want to make sure that we're playing the right side of these opportunities by looking maybe at buy signals on ConocoPhillips or ExxonMobil or Chevron, by either buying these outright or looking at these for an opportunity to sell premium while it holds up in these higher levels. It's what it looks like to me. Well, we're going to wrap it up there. What it comes down to is be careful. There's not a lot of news going on tomorrow, and so we will see a continued flush out of the traders. We'll see probably a lot of choppiness and indecisive behaviors going into tomorrow, but if the volatility is rising, we could continue to see a pullback as we price in this new debt ceiling. So be safe, and we'll talk again next week.